I want to focus for a few minutes on one of the main advantages of investing in cash flowing properties, right? When we talk about investing in real estate, I didn't come up with this. I've heard a lot of people talk about it. They say it's ideal, IDEAL. The advantages are you get income, depreciation, equity, appreciation, and leverage. And those all, of course, have their different components to them. Today, focusing on depreciation because it means something different for a lot of investors. And I would highly caution you, talk to your CPA about this. If your CPA doesn't have clients that are real estate professionals, it's time for a new CPA. That's the thing I'll say most confidently in this. But I want to give just a quick highlight on what we're talking about when we talk about depreciation. So anytime you take depreciation on real property, right, the IRS lets you take it over 27 and a half years on the sticks and bricks, the vertical improvements of the property, right? So in theory, if you had $100,000 of sticks and bricks, divide by 27 and a half, that's your annual write-off that you get, your depreciation that you get to claim. And it's great because you didn't spend the money to get it. It's a passive loss, right? Well, that only goes so far for most people because the IRS makes you start to phase that out the more money you make. I think it's somewhere above $100,000 where now you can't take that deduction every year. It stacks up. You can take it in the future. I've heard CPAs call it, this is your passive losses bucket. Losses that have been accumulating that one day you can take. For example, when you sell the property to maybe wash away some of the capital gains or something like that, right? Well, what I call the holy grail of real estate investing is when you can take those losses from passive to active, right? There's a test that you can take, not literally, but yet there's criteria to pass to become a real estate professional, to get that classification on your taxes. You're spending a certain amount of time investing and you're doing a variety of other activities where you can legitimately claim that, hey, this is how I earn a living. And when you do that, the cap that they put on you is lifted. You can have unlimited active losses in your business, right? So now if you have a lot of rental properties and you've lifted the cap on the losses, you can really give your taxes a kick in the pants in a good way and lower them because you've got a lot of depreciation coming your way. That's a really simplified version of real estate professional status, is we're going from passive to active. And where it really gets cool is I see it a lot of times, a married couple, one is a spouse that's earning W-2 wages. The other maybe isn't working and they can claim real estate professional. Like I said, that's up to you and your CPA to talk about if that's appropriate or not. But one spouse claiming real estate professional can do some serious damage to the taxes owed by the full-time spouse. And once again, I mean damage in a good way because they've got all those passive losses applied against the income taxes for the active working W-2 earning spouse. It's a pretty cool classification, and it gets even juicier when you can front load some of that depreciation through cost segregation studies and some energy efficiency studies, which we could talk about another time. So if you want to be a real estate professional, like I said, there's a lot of CPAs out there that really specialize in this. Personally, and one I refer a lot of clients to is Kohler and I are CPAs, right? They've done a good job for me. Contact us. We'd be happy to put you in touch. But some of the classifications for becoming a real estate professional, you got to have some properties, right? You can't say, I make a living doing this and you've got 2 properties. So generally, once you have a few more properties and you can say there's some income coming in here, that's probably a good litmus. I know that one of them is that you have to spend 750 hours a year of material participation. And I've heard so many definitions as to what material participation means, but people keep a log of, I talked to the property manager, I've done this, I've done that. Some people say if you have property managers, you can't be a real estate professional because you've outsourced it. I'm not a CPA. I'm somewhere in the middle on that. I think, depending on the time and the activities that you're doing, you can make the case that yes, you are a professional. One thing you don't have to do is have a real estate license, right? You can earn a living in real estate without being a licensee. You own a bunch of properties, doesn't mean you have a license. Although most people seem to think it doesn't really hurt if you have a real estate license. So there's a couple of things beyond that. Like I said, it's a conversation between you and your CPA. Ultimately, some CPAs are extremely cautious. They say, letter of the law, you got to do these things. You're going to get killed in an audit. Some people are willing to take a chance. I don't know. Like I said, talk to your CPA about it. But if you get to the point where you can do it and it's clear and you definitely legitimately are a real estate professional, I don't know if there's a better tax advantage than that.